go. It is Fed Day. Let's go. Hey, what's going on, everybody? This is the blockchain backer, bringing you the latest cryptocurrency news and analysis. Welcome to the Federal Reserve rate cut live stream, where we live stream the FOMC meeting. We live stream what the rate decision is, and it is anticipated that there will be another rate cut today. And so if you are watching the replay of this, you can go ahead and skip forward 3 minutes from right now, and that will be the release of the rate cut or pause or whatever ends up happening. And you can skip ahead 33 minutes to watching when Jerome Powell comes up. But that's pretty much how things are going to go right now. In about 3 minutes, we're going to get the decision. We'll be over here on the Federal Reserve's website, and we'll be F5ing, refreshing that page, seeing what the decision is and when it comes out. It's anticipated that it will be a 25 basis point rate cut, or 0.25%. The 2-month yield also indicates that it will be 0.25% as well. And we are about 1 minute and 40 seconds away from that happening. Now, if you recall, we did have a 50 basis point rate cut, or 0.5%, at the last FOMC meeting, which was on September 18th. So it's pretty much just been dark for almost 2 months at this point. They gave a 50 basis point rate cut right before the elections. And they obviously have, as you all know, we've gone through this big hiking cycle. We've been in this pausing cycle for like almost a year. And then finally, they did 50 basis points in their last meeting before the election. So now, of course, we're going to go through this. We've been through the election. We know who the winner is. And now it's time to see if the Fed is keeping their word, or if that was a political play. They say that they're not political, but we'll find out and see what they say here and see what their forward guidance is moving forward. So what happens here is this is going to come out in 1 minute, and then in 30 minutes after that, Jerome Powell will come up on stage, and we will play that. That's what I have down here at the left corner of the screen. I'll make this thing bigger, and we'll watch the charts of the market, and then we'll see what happens after all this stuff happens. Now, when Jerome Powell is done speaking, I do actually just kind of end the stream right after that. Whether markets go up, whether they go down, whether they go sideways, I just kind of conclude the stream at that point. There's no real analysis or discussion to have on what the immediate price action is. It can be incredibly volatile. We can go up, down, and not know what the clear direction is, especially here in 10 seconds when this comes out. If it goes down and then Jerome Powell comes out and talks, it can go up. Or if it goes up right now, Jerome Powell can come out and make it go down. We don't know. We'll find out as things go. So here we are. We are at the point of F5 or refresh, where we just sit here and wait for the decision to come out. There it is. 0.25%. So 0.25% is what the cut is. Let's see what's happening to markets right now. You can see an immediate reaction over here on the Russell 2000 happening right there. We'll see what ends up occurring in here. So we've got a 0.25% cut. Bitcoin waddling around in here, of course, at a new all-time high. Congratulations to everybody, $76,600. And we're watching the Russell just kind of waddle around in here in this minute of this release. So let's go ahead and read what's going on in here. Recent indicators suggest that economic activity has continued to expand at a solid pace. Since earlier in the year, labor market conditions have generally eased, and the unemployment rate has moved up but remains low. Inflation has made progress towards the committee's 2% objective, but remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to lower the target range of the federal funds rate by 1/4 percentage point to 4.5% to 4.75%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. Okay, this is pretty much the same paragraph we get every single time. So how are we reacting currently right now? No big, strong reaction coming from the U.S. stock market. And we'll peek over here. No big reaction happening here in the United States stock market at this point right now. Bitcoin kind of waddling back and forth between a couple of $100 up in here. A quick little pop right there for the Russell, but then things kind of stay tame right in there. As for gold, gold had already popped up prior to this, so gold pulling back a little bit. DXY pulling up a little bit. Hard to say that's anything as of yet. So anything else to cover in here as we await on this? I think that's really it. So, all right. So how this will go now, essentially, we're pretty much just going to be burning time for about 28 minutes until Jerome Powell comes up on stage. So essentially just kind of hang out in the chat, field questions, wait till things happen. But we don't see any crazy reaction happening in markets as of yet based on what we just saw. So quick little pop up, then right back to where it was for the Russell. Quick little pull down for Bitcoin, but still just kind of hanging out right there. Gold, I mean, these moves are all really tiny. So I don't think the market in any way is surprised by anything. And that's representative by a 97% probability that we were going to have a 25 basis point rate cut. And really, once again, the 2-month yield accurately predicted it once again that it would be 0.25%. So that's where we're at. Now we essentially just wait it out until we can end up getting Jerome Powell to come on stage and tell us if these things are going to continue for us. But otherwise, another green day. Yesterday was massively green. Of course, you guys all know it. The election came to a conclusion once the election, or we got into election night, right? I think it was like right when like the first polls closed, maybe. I think the first polls closed, which, you know, happened right here at the start of the new day. And then, of course, markets started rocketing right away. The Russell 2000 goes into its breakout. Bitcoin 2 hours later goes into its breakout, into its new all-time high. And now we're all just kind of living the dream, just kind of chilling, waiting for things to kind of kick in and get really exciting in the market. But this is the first step. And seeing that happen on the Russell, of course, was just massive, massive, massive. We've talked about it way enough. I got absolutely exhausted talking about it. Absolutely exhausted. You guys were tired of hearing of it, and I'm glad that we get to look at it from a different perspective at this point. So there we go. All right, so we'll just hang out in the chat, and we're just going to kind of wait about a half an hour, 26 minutes until Jerome Powell will come up on stage. And so just so you guys know and understand the format of how that does work, I essentially will take this guy and I'll put him right about there, and then we'll play Jerome Powell. I put myself on mute, I go quiet, and then we just wait for things to progress themselves through the meeting and see how markets react through that. Otherwise, I think the market cares way more about that we are through the elections and there's certainty on what to do forward, how we're moving forward. Kimmy says, how does TIA look? I don't have TIA pulled up right in here. It's doing the same thing the rest of the market is doing, essentially. It did like an ABC right in here as well. All right. We got a new member we have a member for 18 months, but there's no name. And it says message retracted. Mo419 with a super chat. How many days did RTY take from the breaking all-time high cycle top back in the tech bubble? How many days did RTY take? It only like 83 days. Let's see if that's right. I believe it was 83. Uh, 72. Why did I? Oh, wait, was that right? Yeah, 72. So, you know, the whole move, the whole exciting thing, it only lasted 80 days. That's right in line with what we typically see in this market when it comes to exciting things finally catapulting and getting on their way. So, you know, if something like that happened and chaos erupted in this market, you know, I've been through a few of these different kind of euphoric moments in the market. They always happen really quickly, and then they're suddenly all over. Just I don't even think we were really euphoric starting right here back in October. I think, I don't think we were really or that York. That was 140 days. That's actually like a lot longer than what they typically are when the exciting phases are happening. Really kind of this ending one right in here. This one lasted 51 days. That's kind of in line. I think like in 2017, XRP went from like 23 cents to $3.40, and that did it in 23 days. And that was the whole bull run. It was in 23 days. And so if things kind of kick off and get moving and we end up seeing this thing start to break down in here, like even this, like having an understanding, this was the whole cryptocurrency, altcoin bull run that happened right here when this dominance was falling. And just to kind of have, like, that was the whole bull run. And that was 49 days. So it just kind of puts into perspective. Once things kick in, they haven't kicked in yet. Once they kick in, they tend, and like, it's just like this, taking all this time, and then the whole thing is 49 days. And that's usually how it goes. And it just kind of waddles at the top, and everybody kind of keeps screaming that we're going to keep going higher. And then it just kind of distributes on everybody at that point. So we spend a long time at the top. We'll spend, however, once it ever takes off, we'll spend 50 to 100 days working our way up there, and then it'll distribute for 200, right, before it finally turns itself around. So, all right. So if you're just tuning in, you're wondering what happened. It was a 25 basis point rate cut by the Fed. I hope I didn't say hike earlier. It was a rate cut by the Fed. So we did drop by 0.25%. No crazy immediate reaction from either one of these, from the stock market or from the cryptocurrency market at this point. The cryptos are pretty much exactly where they were prior to this happening. I think XRP was even at 55 cents, and that's where Ethereum was as well. So there's been no real drastic change that has come from that. The big news, of course, this week is that the election is behind us, and that's historically a positive thing. I think the big wondering is, what is the forward guidance going to be like now? Because one thing we've talked about a lot, so inflation, right? And I don't have these charts pulled up in front of us, but inflation's worked its way down. That hasn't really been a topic to talk about a whole lot lately. But it was anticipated that that final reading before the election would be kind of how low it would go. The fallouts of the readings moving forward, I think we're going to see CPI, the year-over-year CPI, gradually tick back up right now. So where we're at right now is pretty much where we're at. It's going to be harder to get any lower in the short term of where we are right now. So we'll probably get a CPI reading between now and between the next Fed meeting. And so we'll kind of hear, what does the Fed have to say right now? Are we still going to keep these rate cuts coming in, or how aggressive are they going to be? Is the market going to be happy, right? Like we're at restrictive policy. They did 50. It's like, okay, great. So we're coming back down, right? Now they're only doing 25. Well, it's like, okay, well, how long are we going to take to get back down? What are you doing next time? 25? Are you going to have more pauses? What's going to end up happening? So just kind of hearing what they have to say. Again, the market's never happy. Market's never happy with what they want. They always want more. Whether we're hiking and they want them to pause, or we're paused and they want them to cut, or they're cutting and they want them to cut faster, market always wants more. Matt Smith says, my brother, I've never been able to make it on the Wednesday live streams anymore, but I just wanted to tell you I'm always there lurking every video. Thank you for everything you do. It's go time. Matt Smith, thank you very much. It's very generous. And Matt, you've been around for years, brother. Thank you. Kemi. Oh, we already got Kemi. All right. Flagrantly obtuse. Member for 16 months says, given the Russell breakout and the current landscape, what are the projections on XRP? It's going to move with the altcoin market. I know people hate hearing that. It is going to move when the whole altcoin market moves. The flip the switch, the do its own thing narrative has never been true. It has always been when the rest of the market is moving. And somebody asked me this in the live stream yesterday. Can you give all the different targets of failure or breakout or everything, and we can make all these different things? My thoughts are it's going to break out, right? My thoughts are it's going to get to $7 to $10, $8, $9, $10. But we have to keep an eye on it when it does to make sure that is the case. Otherwise, it looks perfectly fine to me. I have more XRP right now than I've ever had. TG, not caught you in a live in a while. My kids are crazy, but I always catch up later. After, I wanted to thank you for your calmness, your logical thought process, and your guidance. TG, thank you, man. That's gonna be the tough part too. Is in the event that this happens, remaining calm during all of it, because it's kind of like PTSD of what we experienced there in March. If this thing ends up going, it's going to be that same stuff again, where I'm going to come on here, I'm going to be like, I'm selling stuff, but it's not going to be like that on Twitter. It's not going to be like that on the content creation. It's not going to be what people want to hear. And the harder part too is this is the moment where everybody pours into the market. This is where all those retail investors who have walked away from crypto for so long, they come pouring in. They come into the market right when it gets really exciting. And you're like, hey, I'm selling. And then everybody seeks out the voice that will tell them it's going to keep going up. But just no, we're going to do that. All right, that's what's going to happen on the channel. I tried to warn that of when we would get to the 702 retracement that would happen. I'll warn you ahead of time. If this ends up happening, I will come on here and just say I'm selling stuff. And especially if we see something happen like this, where Bitcoin's roaring, then Bitcoin tops right here, and Bitcoin goes back into this retracement, but the altcoin market does that, and Bitcoin's like in a retracement like this, it won't matter what prices things are at. Either some stuff once again failed and did not expand, like we saw in 2020 or 2021, where only 20% of assets set new all-time highs. I'm going to guess that's probably going to happen again. It would be insane for it not to. There's so many assets at this point. You would have to think only 20% of stuff is going to set new all-time highs. And, of course, I've placed my bets to hope that I've captured as many of them as I possibly can. But, if that exact thing played out right there, if this extra leg happened here in the altcoin market in a setup like this, I would be very convinced that's the end of the market. But that would be a big run. I mean, we're talking a market cap increase of almost 10x from where we are right now. It could happen in lightning speed. Steven says, how does reverse repo look in your opinion? I haven't looked at it in forever. I just don't think there's any signal there anymore. Oh, it's almost empty. Right. So again, this was one of those things that just reiterated that crypto and liquidity and the stock market and all those good things, right? That when the reverse repo opened up, that's where we topped out at. And then when the peak of the reverse repo happened and the money started flooding back into markets, that's where Bitcoin ramps its way up as well. Then it kind of stalls out in here, and look at that, another drift down. There's still a little bit more in there. I don't know what to say more about it beyond that. Just, it's obviously almost drained. But it doesn't necessarily, just because it's drained, it doesn't make it the sole factor on a bull run, right? I mean, it was not a factor here, but it certainly was in here, right? Just where does liquidity come from at that point, right? Thank you, Stephen. Abdullah Alugab. Member since 2021. Let's go. Hey, BCB, do you expect XRP to go down while the Bitcoin goes up? And what percent? What? No. I don't expect XRP to go down. John FX. Assuming there's a big crash in markets afterwards, a period of euphoria, what kind of assets will you be looking to generate income or growth during worse economic times? There do become time periods where it's just cash is king. I know we all want to You want to sell something, you want to put it into something else that's immediately going to make money. And sometimes it's not as sexy. Sometimes it is simply just buying treasury. Sometimes it's simply just high interest savings account, or, you pick up on the skill to learn how to short markets. But the hard part is the question is whether or not gold is that answer, right? I mean, that's the big thing. And I debate that and constantly fight with that in myself at all times too. However, during like liquidity events and liquidation events, if that were to end up coming, gold still struggles in those types of liquidations. So just because you sell the top of something and then you rotate it into gold, it doesn't mean gold isn't going to have some 33%, 35% flash crash that could happen as well. During a liquidity event, we saw that during C19, it did that. But, it may just be, putting into things that are just high bearing interest, kind of safety cash. Cash is king sometimes, and that may be the play for a little while. Yo Pilot gifted 5 BCB memberships. Yo Pilot, thank you, man. Matty B, member for 22 months. I'm actually in the USA. I'm in Vegas, and I've never heard a BCB live stream in the actual morning. Thanks for everything. Matty, 22 months. Thank you. Oh, there's BC Barker. All right. Austin, you timed the top of Bitcoin perfectly last cycle. No pressure. What would your price prediction be for Bitcoin this time around? I'm a huge fan since 2020. Well, just based on measurements, it's hard for me to see anything higher than 107 at this time. I just don't see anything higher than that. Bitcoin measurement wise, we were able to use fibs on that pretty well. So we could get reasonably close, right? This one I think is going to be a little bit more difficult. But just measurements of A to B, C to D, it puts you there at, about 107. That's just my current guess. Then Yo Pilot gifted another 10. Man, thank you. But there were interesting things that and I haven't had a chance to do. I was just trying to think of a video idea. I had put out a video today, but I always try to think of are there any other video ideas I can think of too? And one of them with what we talked about, I need to go back and find the video. You'd have to. I can't remember the name of it. I don't know why it's not hitting. The bear strikes the Bitcoin price chart. That's the name of the video. If you want to search it up, blockchain backer, the bear strikes the Bitcoin price chart, right? Where it was confirmed Bitcoin is in a bear market. And we came up with 3 different hypotheses on how Bitcoin would correct down in here. And one of those ideas was that it would be something like this, and then it would go down to a new low and break out, but that it would kind of quickly recover in there and do something like this. And then, then it kind of goes down like that. Like an example of a correction kind of like that is this one right in here. You can see I was playing with it this morning. It's kind of like this, and it's a working idea. I'm not married to this by any means. But that, here's pretend this is April and May of 2021, right? We fall, everybody just admit it's a bear market. Then we go set the new high in November, right? And then you come down here and waddle for 3 or 4 months, and then you set the new low, work your way back up to the height, and then do a bull flag, and then kind of break out, right? That in that video, and I'm going to, rather than just giving you the kind of the, what do we call it? what are they calling notes of a, I don't know, the brief explanation of it. Essentially, that's about as far as you get out of there, and then things kind of get sketchy for a minute. The thing about that, so the problem with that, right, is in that idea, it would be that it actually would have been short-lived. And so when it came time to it, when we got in here, this wasn't short-lived. It took a very long time for this to play out. And that idea would have been that would have gotten back up quite quickly. But it kind of did that, caught everybody by surprise. Kind of, there's a lot of looking for 12K, right? There's a lot of looking for 83 to 85% drawdowns at the bottom, looking for it to be kind of the standard typical bear for Bitcoin, and it didn't end up doing it. But that's still there. And the thing that makes it hard and why we keep reiterating all these things is that this market is definitely different. This is not your 2012, 2016, and 2020 market. We got a new high. We got it on the Russell break-in, but it's not the same market in that in all three of those past markets, they were expansions in equity markets. And this isn't an expansion, at least not yet. This is not evidence of an expansion in equity markets. It's more likely, in my opinion, going to be a rotation. And I could see a narrative coming along with it. Like one of the narratives, I think to myself, like, all right, what would the narrative be that Meta, Amazon, Apple, Google, Netflix, that they sell off and the rest of the market's running? And how would retail investors interpret that as being completely fine and it doesn't matter? It doesn't mean we're in a rotation market. It just means it's completely fine. And I think with the changing of leadership with the US elections, that there could be a really good FUD story to say that these guys maybe try to influence elections. And so they're selling off because people hate them. And I know that's crazy thoughts, but I'm just trying to think of narratives on how would people not see it, right? And that's the reality, because that's what always happens at every peak. People just don't see it. So how could they justify it being okay that Amazon, Meta, Apple, Google, they're all selling off, but everything else is ripping? Because they're like, yeah, man, greatest economy ever. That's because those guys, man, they were trying to influence stuff, right? It doesn't matter, but it actually does matter because it's actually a rotationary market happening there. This is not political, right? This is totally just trying to think of narratives on how those things could end up happening in there. But anyway, right? So it's not an expansion like we've historically seen in any type of Bitcoin all-time high. It's associated with all the indexes and all the broadening happening together rather than consolidated into things like Apple, Google, Amazon, Netflix, and whatnot. And so that's why we keep kind of talking about that. What do rotational tops look like? And if we end up getting that, where it's Amazon and Nvidia and Apple and Google, or they're all pulling back, but there's some story to go with it that we're all like, it's okay, it's normal, it's fine. It's because, those people, they suck, right? That we have to say, no, I don't think it's that. I don't think that's it. I think it's actually a rotating market that's happening right now, and we have to be mindful of that. We're not there right now yet, though, right? I think the first step is obviously going to be Russell getting to the all-time high and then seeing how those react. And I put that in today's video. I kind of gave an example of what that looked like when that occurred at the peak of the market back in 1999 and 2000. And that's the same thing that happened with Bitcoin back in 2017. And I'm going to assume only about 15% of the people who are watching right now were here through at least most of 2017 and can reflect on what it was like, how there was an alt season that happened in the first half of the year between like March and June. And then Bitcoin continued roaring all the way from June all the way to like December. And the altcoin market did not participate. We had like this lack of breadth happen in the crypto market. But the second that the profit taking began on Bitcoin there at $17,000, that is where finally the crypto market came alive. And we're talking back in here, right? So there was like an alt season that took place through here. And then after that, alt season canceled at this point. Bitcoin rips, and then it takes this first profit take right here This is where alt season begins. And just an example of that. Like that, right? So if there's like some major profit taking that happens over there, and those stocks, we just got to be mindful of it. All right, I got to stop rambling. We're just doing way too much talking here. I got to get ready because Jerome Powell is going to be on in 3 minutes. Sexona says Ethereum price prediction. Why no one talking about Ethereum? Yeah, everybody's fudding it. Usually when things are fudded, that's the best time. We'll have to do that on another time, buddy. I got to get ready for this thing. We're starting. Jerome's coming on in 2 minutes. I got to get through the rest of these. I appreciate it, though. Mod Barber, thank you, BCB, for all the support. You see Bitcoin having a flash crash to the low 60s, as lots of analysts are predicting? To the mid 60s? I don't want to mess this chart up. To the mid 60s? I don't see why we would. I don't see why we would, unless if the top is already in. I don't see any reason to revisit the mid 60s now. We're talking like down here. I mean, we're just building series of higher highs and climbing. I don't see any reason to have to pull back down in here again, unless if the top is in. We've already retested this area as support. I just don't think it will. Do you see wildness, then a small crash before Christmas, then wildness? Okay, I'm going to have to get back to these later, guys. We're 1 minute away from Powell. I'm sorry. Okay. All right, I got to turn the audio off. Here we go. Turn this. Okay, got to do that. Sorry, guys. A lot of attention. The reason why I have to I go quiet and act weird during that is there was one time. Here we go. If you play 1 second of this elevator music that the Fed has on there, YouTube's like, no, how dare you? And they're like, copyright. But all right, we're good to go. All right, so Powell will be on in 1 minute. We'll go ahead and get these things all set up and ready to go. Why can't I? Okay. There we go. All right, here we go, guys. I'm going silent. Enjoy every hard swallow. Whoops. Can't do it yet. Almost. You almost got me, Fed. You almost got me. All right. What I'm going to do is I'm going to mute my audio. There we go. You guys can't hear my dad. Okay. We're ready.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 0.25 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer-run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timros from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent. And if they're material, then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now? You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
You know, we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September. And in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. You know, we're just going to have to see where the data lead us. We have, you know, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but you know, I would say, you know, I would say that. You know, again, we didn't update the SEP, so I'm not going to characterize, you know, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we net that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And you know, saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. You know, there's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and are rising deficits a concern to you?
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that At a certain point, we'd think we see the outline, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, you know, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And, you know, you'd start to put it, you'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, you know, we have a very large economy. Many things are affecting it at any given time. And, you know, a law change of some kind would go in there, but it would, you know, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And, you know, the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly, and this will be no different. But you know, right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of, you know, when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question. Are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
Look, I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, you know, 3 weeks later the 10-year was 50 basis points lower. So, you know, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, you know, we're watching it, we're reading, you know, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at the 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing, we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place. And our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria.
Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their world, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like, clearly, geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as, something that's on the horizon all the time. But, ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year, I've heard this from several people, that next year could even be stronger than this year.
Andrew.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is, to follow up on Victoria's question, do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage, and so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. So there's, this is a thing where we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important, the precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of neutral, a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now, but as we move further, there will be more uncertainty about where that is, and we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Erminovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen, up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022, was to avoid that.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is, it takes some years of real wage gains for people to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down, the economy is still strong here, wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened, but it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true, they're accurate. We don't question them. We respect them.
And just a quick follow-up. President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
So that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
There we have it. Mr. Jerome Powell exiting the stage. That was interesting, right? I mean, his tone was very different from what we heard last time. Last time, it's like, yeah, we're coming out, guns are blazing, cutting rates, let's go. He just came out and, I'll dare say it, made it sound like they're not even going to cut next meeting. It's what it sounded like to me. I already know we talk about that inflation metric stuff all the time. It is unlikely that inflation will tick down during the next inflation report. And by the time they come out, if they're going to be true to that, makes you wonder if the whole thing was political of them doing it anyway. And this was this 25 basis points was them just keeping their word of what they had said in the last meeting. Because the tone, I bet if we go back and rewatch last meeting compared to this one, that tone was completely different. Either way, we didn't see a whole lot of volatility in the market during that. As a matter of fact, the Russell 2000 is higher than when we actually got the reading. The reading came out right here. There's a quick reaction, and then all this during the stream. Now that it's over, Russell is up. Bitcoin's back up here near the high, so there's no real drastic change. I often think a lot of times as we head into these Fed meetings, the market's kind of repricing itself and getting itself prepared for that, and then it reprices itself based off the new information that it ends up getting. We had such a huge catalyst already happen this week. Probably this market just didn't even have time to appropriately position itself to intake any of this information. So I think the market just kind of reacted based off what happened on Tuesday. And it's the most logical thing I can make out of it. Either way, we've got a green market here as we close it out. So things are okay. And Bitcoin's just teasing like it wants to go into a new high before we wrap this thing up. So I'll go ahead and answer the last super chats that I missed, and we'll go ahead and go through the wrap up. Black Cat had asked earlier, do you see wildness, then a small crash before Christmas, then wildness after that? Seems market goes down in December. I think there will be some form of a correction. I haven't spent enough time to sit there and say it'll happen like in the next 23 days, and then it'll pull back. And that's a hard question to ask. Will it crash before Christmas? They go back up, and they crash again? I'm not quite sure. Austin, thank you for the super chat, Black Cat. Austin asked, what would the market conditions need to be this time around for you to start selling your bags, other than retail euphoria and media, considering your theory of rotational tops and not expansions? I'd have to see it at the time. I kind of have an idea on what we talked about earlier in this stream, where if Bitcoin's not setting a new high, but you're getting that secondary leg over there in the altcoin market. Otherwise, looking for confluence of other things, and I'm not sure what all of those would be currently at this time. The first thing would be like if we got a 4.236 extension off this range that we've been in from March that bottomed in August, right? August 5th, when the liquidation event happened in the market of that range. If we ended up 4.236 extensioning that, that'd be kind of the first thing. And I would, of course, be looking for confluences to be happening at that same time right there. There's a little bit over $1 trillion on others. But otherwise, if other things were happening at the same time, we'd be looking for those and communicating those at the same time. But we just kind of have to wait for those things to present themselves. Otherwise, market did all right. Andy was sitting there giving all those stickers during the stream. Thank you very much, Andy Philpott, my brother. It's good to see you, dude. Robbie says, been watching since 2020. What's your selling point for extra pay? I think you said around $9. I just wanted to be sure. Yeah, I'm going to ladder up in there, but I will have 65% of it by the time we get to $10, if we get there. Shout out to BC Barker, the dog. Yeah, he made an appearance. Kishop says, did you degen on First Ledger? I have degened on First Ledger. I've spent a lot of time over there getting my, the term feet wet. And I've gotten fairly good at it. Definitely about, from my starting balance of what I started with, about 100x. So if you're not playing on it, just know it's like the most riskiest thing in the universe, right? If you don't know what you're doing and you're not fast, you will get lit up very quick. So, all right. Well, we got a new all-time high for Bitcoin. How about that? There we go. That's how we end the stream. That's how we end the Fed meeting. Another new high for Bitcoin. So, all right. We'll go ahead and go through the wrap-up, guys. Thank you so much for tuning in. Thank you for being here. We'll check on it tomorrow. And hopefully the good times keep on rolling. So that's going to be it for this one. Thank you all so much for watching. All-time high for Bitcoin after the Fed meeting. Let's go. Boom, 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 boom. You know, I did have it prepared. Do we do it? Do we do it? Do we?
It is Wednesday, my dude. It is Wednesday,
It is obviously Thursday. It is obviously Thursday. But normally these Fed meetings are on Wednesdays. But I think due to the election, they pushed it back a day. But there you go. New all-time high for Bitcoin after the Fed meeting. That's going to be it, though, guys. Hey, thank you all so much. Microspec says, can you check the GME on Solana chart? No. All right, that's going to be it, guys. Thank you all so much for watching. If you could, please like the live stream and give it a thumbs up. If you are new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice and I am not a financial advisor, but if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Have a good one.